What are you watching most closely right now?
I think what we've seen is the old adage that the cure for high prices is high prices. We'll probably see a little bit of a weaker jobs number today, but inflation expectations have actually been coming down steadily for months. The headline is that oil has pulled back, but if you look at those break evens, they've been coming down since April. And in fact, the 10-year break even is getting close to 2%, and even the 2-year break evens pulled back. So that's kind of the good news. The bad news is, of course, that that's some indicia of increasing concerns of economic weakness.
Do you feel like the stock market is closing in on some kind of a bottom? Maybe not this is the bottom, but getting close?
Well, the question is what's priced in. So, here's one way to think about it. We have some pretty decent fundamentals. Things like ROE, sky high. Things like leverage, crazy low. I mean, net debt to EBITDA is below 1. So the fundamentals are pretty good. And we're trading at 17 times for 2022 consensus estimates. That should probably be 20. So turn that on its head says to me that the market's priced for something like maybe a 10 or 15% miss of those expectations. That's one way to quantify what's priced in. Is it enough? I think you'd say that equities are priced for challenges, but certainly not catastrophe.
Yeah. And listen, I like to be sunny side up Sullivan, Simeon. Nobody wants to hear doom and gloom at this hour. I get it, but you had the former Prime Minister of Japan, Shinzo Abe, was assassinated. Boris Johnson stepping down. Germany is already starting to ration gas, dim lights, close swimming pools, and it's summer. You just wonder what the winter will bring globally and whether it's worth it to take a at least near-term risk on equities.
Well, certainly our thoughts and prayers are with the people of Japan, and that was just shocking news that we all woke up to this morning. And of course, the departure of Johnson. But neither of those things are likely to change any policy directions. Brexit's still going to happen. Japan's still going to likely have easy money. But there are, of course, some substantial upside opportunities too. Let's pray for an end in the war in Ukraine, and of course the reopening or tentative reopening of the Chinese economy that could resolve at least some supply chain issues are things that reside on the other side of the ledger. So absolutely, there are risks of weakness in the global economy. Some of that is reflected in stocks, maybe not the worst of possible outcomes, but a decent range of them are priced in.
Yeah, so you feel like we're priced into challenges, as you say. So would a 15, 16 times multiple on $205 earnings for the S&P, does that seem like a reasonable number to you, Simeon?
If we make those consensus numbers, I think that there's upside in the market for sure. But we did see in Q1 some indication of things that people are worried about. One of the biggest things that folks are concerned about is margin compression. And in the first quarter, the S&P 500 tallied up 13% top line growth, but only 7.5% bottom line growth. That's what people are worried about, because in an inflationary environment, can you pass all those costs along? Among the things we note, look for companies that can actually sustain those margins. As an example, the S&P 500 dividend aristocrats, those are those consistent dividend growers. They took that same level of 13% earnings growth and turned that into, sales growth, and turned that into 20% earnings growth. So that's an opportunity. And we'd also point to credit. With leverage so low and spreads have actually widened substantially this year. If you look historically, if you plotted 1 times net debt to EBITDA on investment grade credit, you'd get about 100 bips of spread, and we're at 170. And remember, fixed coupon bonds are like a fixed coupon mortgage. So a little bit of inflation, even if it doesn't always make it to the bottom line, still makes it a little easier to pay off those debts that are higher in the income statement.